Everybody, I am joined by one of my favorite fools, John Quast. We are going to be talking about some stocks you might not have heard of. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now from the Motley Fool. They're our sponsor, and it's the best way to support this work we are doing on YouTube. So, without further ado, let me go ahead and I'll kick it to John because actually I was surprised in doing a little bit of preparation for these videos. John has a lot of stocks in his portfolio that I haven't heard of. And I kind of consider myself to be fairly knowledgeable about the stock market. So, John, which one are you going to talk about today?
Yeah, thanks, Matt. It's a blessing and a curse. I like to go off the beaten path. And with this one, not so far off the beaten path for those who live in the Southeast like I do. This is called Driven Brands, ticker symbol DRVN. This company owns a lot of oil change places, a lot of car washes, a lot of body and collision services, a lot of them under the Take 5 brand, if you're familiar with the Take 5 brand. And yeah, over 1,800 oil changes, over 1,100 car washes. It's a very big company. Now, what makes this company a little bit tricky for investors, and I think why a lot of people haven't enjoyed this stock recently, is that it's a growth by acquisition strategy. A lot of private equity background managers who are just rolling up companies, taking on a lot of debt using that strategy. So this is a company with a lot of debt, 2.8 billion in debt. And so with that, with higher interest rates, as you know, over 30 million quarterly right now in interest expenses. So not something that's really appealing to a lot of investors right now. But here's what's kind of interesting to me and why I like this company right now. It's still a profitable business, right? And this is also something that kind of always in demand. Things would have to get really tough before people start getting rid of their oil changes, right? Stop washing their cars. I mean, things would have to get a lot worse in the economy than they are right now. So this is something that enjoys steady demand, profitable. And this company is expecting roughly 500 million in EBITDA this year. So that's the adjusted earnings appropriate for a company like this when you factor out those interest payments and stuff like that. But as far as the enterprise value of this goes, not a very big company, only 5 billion in enterprise value, expecting 500 million in EBITDA this year. And by 2026, expecting up to at least 850 million in EBITDA. So with interest rates potentially coming down, you might see this valuation go up a little bit. At 12 times its expected EBITDA in 2026, you're looking at a $10 billion company versus 8 billion or 5 billion right now. So potentially a double over the next 3 years. I like the setup.
Yeah, so I'm in the Southeast, and now that you mentioned what they do, I've definitely been a customer. I'm sure a lot of people are in the same boat. They just don't know the parent company's brand name. It's a really interesting play, and it's kind of an evergreen business that people need no matter what the economy's doing. Like you said, I'm always going to have to change my oil in the car. That's not something you really want to skimp on as a vehicle owner. So that's one that the Southeast is very familiar with. And I like you mentioned the interest expense because that's something a lot of people really don't think of. There's all this focus on adjusted EBITDA, and that's what the I means before interest. So
Right.
it's definitely something that can trickle it down to the bottom line over the next couple of years. I like that one. So I'm going to talk about one that people from the Northeast are probably very familiar with. I don't know, John, if you've been to the Empire State Building in your life.
I've not.
If you're afraid of heights, don't go. But if you are not afraid of heights, it's definitely something to check out once in your life. So I'm going to be talking about Empire State Realty Trust. Ticker symbol is ESRT, a stock that I'm very familiar with that I've held for a while. It's only been public since 2013, but it's been an investment partnership that people could invest in since the 1960s. Still run by the same family that bought the Empire State Building in 1961. My grandfather was one of the original investors. He bought one share of the partnership unit back in the 60s. It's worth a whole lot more than one share was back then. Now it's converted to common stock. So this is a real estate investment trust. It doesn't just own the Empire State Building, even though that's where it gets its name. It owns a big portfolio of office, retail, and multifamily properties, pretty much all of which are in Manhattan. There's some in Brooklyn, but in that whole area. Um, the Empire State Building is one of them, but it owns a total of almost 9 million square feet of office and retail space. Um, if you've ever been to the city, you know that the first floor of pretty much every office building is retail. So that's it. It's not like they have standalone retail properties. They have a few, but mostly it's street level retail. They have 4 apartment buildings in Manhattan with a total of 727 apartment units. 727 Manhattan apartments is kind of valuable, so it's a nice place to have multifamily properties. And one thing that really sets them apart from other office real estate companies is that they own and operate the observatory on top of the Empire State Building, where you would go if you were a tourist trying to, check out the views from the 102nd floor, which is really cool to do. The observatory is one of the biggest kind of X factors of this business. It's a real cash machine. It's got a 74% operating margin. It produces 18% of this company's total revenue from 1% of its square footage. Pretty impressive cash machine. And it's, like I said, it's something that most office operators don't have. That's a really cool part of the business. This is an all-in play on New York City. The company, like I said, the family bought the Empire State Building in the 60s. They know the New York City real estate market very, very well, and they've done a great job of executing. Office real estate has not been the place you want to be in the past few years. This has been an exception. Empire State was up 40% in 2023, despite a terrible office market. They do things a little differently than others. They have zero exposure to co-working space. For example, a lot of, WeWork is a big tenant of a lot of office real estate companies. They have very little exposure to trendy types of offices. They focus on businesses that need office space. The FDIC is a tenant of theirs in offices. They focus on banks. They focus on ad agencies, places that need businesses that need places to physically go to. The Empire State Building itself is just it's an iconic, like a status symbol office building without the status symbol price. It's considered, below a Class A office property, even though it's where everyone wants to be. So it's a great combination of price point and amenities you get. And like I said, that observatory is just great. The multifamily properties are 98% leased. The big retail tenants are companies like Sephora, Target, Ghirardelli, the chocolate company. You're probably familiar with them. They just opened their first New York location at the base of the Empire State Building. It's a really attractive location. And last, and I'll shut up after this, it has a great balance sheet. This is a sub $3 billion company, which with over $500 million of cash on the balance sheet for a real estate company, that's a lot. They have an untapped $500 million credit line. All of their debt is fixed rate, and they trade for just 11 times forward earnings. So really interesting company, and it's because of all that office pessimism that's going on. So I don't know. I hadn't heard of your company at all as a stock. I've heard of their business. Had you heard of Empire State? I know you're not really a real estate guy.
Not really a real estate guy, but this is an interesting company. I remember when it went public, the brokerage that I used at the time was given access to some pre-IPO shares. And so you could invest at the IPO. I really thought about it because I just thought, man, something so iconic like the Empire State Building, that's just very interesting to me. But no, I've never owned it.
Yeah, it's been a roller coaster ride since the IPO. To be fair, the stock is actually below where it was at its IPO. And the office environment was just completely different back then. That's when, it was a pre-pandemic environment. Work from home was not really a thing for the most part, especially in New York City. Why would you need to work from home if you live in the same city where you work, or you can easily commute in? But now the world has changed, and they're doing a great job of pivoting to the new normal. So yeah, thanks for joining me on this. I hope everyone learned something. Please leave me any questions you have. I'll do my best to respond to them individually. I know this is my channel, but if you have a question for John, I will be sure to relay it to him. I'm sure he would love to answer. He likes talking about these, kind of weird stocks, kind of like I do. So thanks for listening, and we'll see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.